A short accounting standard, IAS 34, is the next point in our discussion. The reason why IAS 34, I called it a short accounting standard. In real life, in practical application, there are multiple nuances with it. Then there is a separate review standard in audit with respect to interim financial information. But in our exam, from an examination standpoint, uh, this particular accounting standard is not so significantly important, is what the ACCA body has said. So if you are writing the diploma IFRS exam, then you just need to have a basic understanding of the fact that there is a standard on interim financial reporting, and just be content with that much information. For people who are writing the Strategic Business Reporting paper of ACCA, on the ACCA Study Hub, they have specifically mentioned that the application of IAS 34 is not examinable. So you will not be asked to prepare interim financial statements. You will not be asked to comment on interim financial statements. You just need to know what are interim financial statements. So regardless of the course, whether it is Diploma IFRS or whether it is Strategic Business Reporting, interim financial reporting accounting standard is from a theoretical understanding perspective. You are not expected to do calculations or preparation of financial statements based on this information. So take it as an easy ride, a simple ride through theoretical concepts without requiring too much focus on the application or no focus on the application. Okay. The accounting standard that deals with interim financial reporting is IAS 34. Interim means in the middle, not at the end of the year. So year-end financial statements are the ones that are prepared for the whole financial year. Interim financial reports are prepared for a period shorter than a full financial year. Interim financial reports are prepared for a period shorter than a full financial year. Entities may be required to prepare interim financial reports under local law or listing regulations. For example, in India, all listed companies are required to produce quarterly financial statements that are submitted to the stock exchange. So there again, the interim financial reporting principles apply. IAS 34 does not require the preparation of interim financial reports, but sets out the principles that should be followed if they are prepared and specifies their minimum content. You see, accounting standards do not make anything mandatory. For example, IAS 16, which talks about depreciation, because it is a standard on property, plant, and equipment, that accounting standard also does not make depreciation compulsory. It does not even tell you which method of depreciation to apply. Who makes depreciation compulsory? The Companies Act makes recording depreciation compulsory. Similarly, interim financial reporting accounting standard does not make it mandatory for you to prepare interim financial reports. But if you are required to prepare interim financial reports as per the requirements of the local laws or listing regulations, then IAS 34 tells you what are the principles that should be followed in the preparation of these interim financial statements. An interim financial report should include, as a minimum, the following components: condensed statement of financial position as at the end of the current period with a comparative statement of financial position as at the end of the previous financial year. Now, condensed statement of financial position as at the end of the current interim period. Assume that the current interim period is 1st of April 23 to 30th of June 23. That means interim balance sheet, interim financial statements are prepared for period ended 30th June 2003. Comparative statement of financial position as at the end of the previous financial year. My current interim period is April 23 to June 23. What is my preceding financial year? My preceding financial year is April 22 to, March 23. So, statement of financial position as at the end of the previous financial year means balance sheet as on 31st of March 23 has to be prepared. So current interim period April 23 to June 23 and balance sheet as at the end of the previous financial year means for the year ended 31st of March 23. Okay, now condensed statement of P&L and OCI for the current interim period and cumulatively for the current financial year to date, if for example the entity reports quarterly with comparatives for interim periods current and year to date of the preceding financial year. Pay attention. For example, so how are you supposed to present information in statement of P&L and OCI? Say my current quarter is July 23 to September 23. Okay, current quarter is July 23 to September 23. P&L and interim financial statement will naturally be for April 23 to June 23. Sorry, they will naturally be for July 23 to September 23, which is my current quarter, and year to date, which means from the start of the year to this date. So 1st of April 23 to 30th September 23. P&L in the interim financial statements will be for July 23 to September 23, which is the current quarter, and year to date, April 23 to September 23, and the same corresponding periods in the preceding financial year, which means July 22 to September 22 corresponding to the quarter and April 22 to September 22. So what do you have to do? Current quarter, July 23 to September 23. Current year to date, April 23 to September 23. Same thing for the previous year. Okay, July 22 to September 22 and April 22 to September 22. Then condensed statement showing changes in equity. This statement should show changes in equity cumulatively for the current year with comparatives for the corresponding period of the preceding financial year. So, current interim quarter is October 23 to December 23. Present for the quarter and for April 23 to December 23. Corresponding values to be presented for October 22 to December 22 and April 22 to December 22. So with comparatives for corresponding period of the preceding financial year, statement should show changes in equity cumulatively for the current year. Cumulatively means show current quarter and show pura ka pura period right from the beginning. So two periods there and corresponding periods in the previous year. Then condensed statement of cash flows cumulatively for the year to date with a comparative statement to the same date in the previous year. So if my current interim quarter is October 23 to December 23, then for interim financial reporting, cash flow will be April 23 to December 23. Comparative figures for April 22 to December 23. Now here, see what they are saying is show it cumulatively. So if my current quarter is October 23 to December 23, you have to present for April 23 to December 23 cumulatively also. Here, current quarter is October 23 to December 23. Show it for the interim period and cumulative right from the beginning till the end of the reporting quarter and corresponding periods. Then you are also supposed to present selected explanatory notes. Okay, and basic and diluted EPS should be presented on the face of interim financial statements for those entities within the scope of IAS 33 earnings per share. When they say select explanatory notes, what they are trying to say is you are not required to present full explanatory, full significant accounting policies, just give the key ones because the detailed ones are supposed to will be prepared at the end of the year and also show basic and diluted EPS in case of those entities which are required to which are required to present earnings per share. And naturally, the consistency principle remains applicable here as well. The same accounting policies should be applied in an entity's interim financial statements as are applied in its annual financial statements. Only then it would make sense and only then would comparison be possible. Otherwise, there is no point of comparison. And the measurement should be made on a year to date basis. Interim financial statements are likely to rely more heavily on estimation methods than annual financial reports. You see, At the end of the financial year, you would have a clearer picture in terms of collectability of debt, how many customers are likely to pay, how many of them are likely to default. All of this information would you would also be able to perform detailed testing, detailed procedures at the year end. In the middle of the year, at the end of 3 months or 6 months, you might not have complete clarity on these points which require estimation. So estimation is way more in interim financial statements as compared to your year-end financial statements, because at the end of the year you have more data and you have more information available with you to arrive at a slightly more accurate version as compared to the interim financial reports. And one term that we were coming across again and again was condensed statement of financial position. Condensed statements, condensed financial statements are presented in considerably less detail than complete financial statements that are intended to present financial position, that is balance sheet, result of operations, that is P&L OCI, cash flow in conformity with generally accepted accounting principles. Condensed financials are a compendium of firm's financial statements, all found together in a single document with limited detail. The kind of, a reconciliation that you would give for say non-current asset, or the kind of detailed calculation or breakup that you would give for debtors less than 180 days, more than 180 days, all of those details are not required. They are presented in much lesser detail as compared to the year-end financial statements. These shortened statements are created to provide a quick overview of company's financial status with limited detail, and often for internal use only. See, in case of stock exchange, where if you are required to submit the interim financial statements, they will lay down a list of disclosures and presentation points that they expect from you. In that situation, you will have to follow those, because local laws will always prevail over accounting standards. But if the uh, local laws are silent in terms of how much detail, then naturally the accounting standard says that you should be providing only limited details in the interim financial statements, which is why they are called condensed financial statements. Items that would normally receive several line items are thus condensed into just one, such as cost of goods sold or retained earnings, or inventory. Normally, you would have a breakup of inventory, which is a raw material, work in progress, closing stock, correct? And your consumable items, and all of these packing material, in all of these would be a part of the inventory. But here you are not expected to give that level of breakup, just one figure would suffice. So that is basically the long and short of interim financial reporting. There was a reason I was calling it limited, and it's a very very short discussion. And as I said, if you are writing the strategic business reporting SBR paper, application of IAS 34 is not examinable. Similarly, if you are writing the diploma IFRS exam, again, detailed application of IAS 34 is not applicable, but it is a part of our syllabus, which is why we have spent a short duration covering that.